The markets at this hour, as I said, now pricing in not just a 100% probability of an at least 75 basis point hike at the Fed meeting next week, but
this will be the fifth rate rise this year. It's the steepest increase in rates in history, certainly since Volcker. But the background of the country today is so different.
The U.S. stock market had a rough week last week. Stocks plunged last Tuesday, with the three major stock indexes having their worst day since June 2020. Following a disappointing consumer price index (CPI) report that showed hotter than expected inflation. The Dow Jones Industrial Average dropped 3.9%, the Nasdaq Composite slid 5.2%, and the S&P 500 fell 4.3%. FedEx took a particularly large hit on Friday, with its price dropping more than 20% after the company warned about a recent downturn in shipping volume and the financial difficulties resulting from that. With such a major plunge, what's going to happen now? U.S. consumer prices unexpectedly rose in August, and underlying inflation accelerated amid rising costs for rents and healthcare, giving the Federal Reserve the ammo to deliver a third 75 basis point interest rate hike next Wednesday. The Consumer Price Index edged up 0.1% last month after staying unchanged in July. Though consumers got some relief from a 10.6% decline in gasoline prices, they had to dig deeper to pay for food, rent, healthcare, electricity, and natural gas. Food prices rose 0.8%, with the cost of food consumed at home increasing 0.7%. Food prices surged 11.4% over the last year, the largest 12-month increase since May 1979. Economists polled by Reuters had forecast the CPI dipping 0.1%. In the 12 months through August, the CPI increased by 8.3%. That was a deceleration from the 8.5% rise in July and 9.1% in June, which was the biggest gain since November 1981. Inflation has overshot the Fed's 2% target. The good thing about the stock market is that if a piece of news is in line with expectations, no matter if it's good news or bad news, typically it's priced in already, says Daniel Demian, strategic advisor at Albert Automated Money Management and Investing App. This means that a 0.75% rate hike, which most investors are expecting, likely won't cause any major waves in the market. What it's going to come down to are the Fed's comments and whether there are any surprise changes in that rate, Demian says. If the rate is higher or lower than expected, the market could respond positively or negatively depending on how the Fed justifies it with its comments. Regardless of what the Fed announces on September 21st, volatility is a natural part of the stock market, and investors can likely expect of it this month. It's impossible to time the market, so experts recommend staying the course and dollar cost averaging your long-term investment goals. Why is inflation so high? Inflation is the increase in the price of something over time. Every month in countries like the US and UK, the government releases a new figure estimating how much prices are rising overall. Many things are contributing to the high rate of inflation, including higher gas prices, oil production lags demand, and the war in Ukraine worsening the squeeze. Rising food prices after bad weather hurt harvests, and the war in Ukraine hit grain production and costs. A surge in car prices due in part to a supply shortage in microchips that dates to the pandemic. Higher rents and home prices after low interest rates and remote work turbocharged the property market during the pandemic. And increases in the cost of dozens of other items, including raw materials and furniture, many of which stem from manufacturing and logistics issues related to COVID. In the US, the rise in inflation started during the pandemic, as government spending, including checks for families, kept demand unusually high. In many other parts of the world, such as Europe, the problem stems from more recent issues like the war in Ukraine. Pay increases haven't kept up with prices, even in countries like the US, where a hot labor market has pushed companies to increase wages. When inflation is taken into account, the average hourly wage in the US was 3.6% lower in June than 12 months earlier. The price for buying groceries and dining out surged again in August and is now 13.5% and 8% higher than a year ago, respectively. The overall food index gained 11.4%, the biggest 12-month jump since May 1979. What effect does the Federal Reserve have on the stock market? Two of the Fed's central mandates are to maintain low unemployment and keep prices stable. It does that through monetary policy, including adjusting the money supply in the country to make interest rates move toward the target rate they set. This year, Due to persistently high inflation, the Fed has raised its target rate 4 times since March. If the Fed decides to raise the target rate during its September meeting, as experts are predicting, it will mark the 5th rate hike this year. Higher interest rates means higher costs of borrowing for businesses and individuals, which is supposed to cool down demand and reduce the growth in prices. However, raising interest rates too high could potentially lead to an economic recession and higher unemployment, which the Fed wants to avoid. How quickly and by how much the Fed increases interest rates can affect how investors see the central bank's monetary policy going forward. If they hike rates higher than expected, then the Fed is seen as being more hawkish. That could turn off some investors who fear that higher rates will lead to higher prices being pushed down to consumers, leading the economy further down the path to a recession. The Fed needs to be consistent to maintain its credibility. The Fed has made it clear that it will continue raising rates for as long as it takes to get inflation under control, and stock market participants have priced this well into 2023. Will the Fed go too far and push the economy into a recession? Globally, most of the world's central banks are on a similar path as the US Federal Reserve. For example, Europe and the UK and India are all raising interest rates. China, however, is not. Europe is facing a potentially serious energy crisis when the weather turns cold. This is because Europe only produces about 42% of its energy needs, CY 2020, and imports 58%. A significant amount of Europe's energy needed was supplied by Russia. Since Russia has closed the Nord Stream 1 pipeline, Europe is forced to replace this lost energy. All of this argues for a more severe recession in the EU region. When you consider a stronger US dollar, which will reduce US exports, an aggressive Fed policy, and a potentially severe recession in the EU and possibly elsewhere, US exports should fall and corporate revenue and earnings should decline. This raises the risk of a widespread recession. How will investors deal with stock market volatility? For new investors, big swings in the market can be a lot to handle. There's a lot of uncertainty right now because of interest rate hikes, increasing real estate prices, and everyday commodities getting more expensive because of inflation. And the market reflects that on a day-to-day basis. But if you have a buy and hold strategy with low-cost, broad market index funds, remember that slow and steady wins the race. The best performing portfolios are the ones that have the most time in the market. Possibly, but there are many factors to consider. Large cap stocks should outperform small cap stocks through the end of the year. If, or perhaps when, the economy slows, interest rates may head higher, which could cause stock investors to move into bonds to reduce risk. Whatever you do, invest early and often, especially if you have a long investment timeline. Dips and crashes will happen, and so will other scary-sounding things like economic bubbles, bear markets, corrections, death crosses, and recessions. You can even take advantage of a dip to invest more, but not if it impacts your regular investing schedule. It's hard to tell when there's going to be a dip or correction, and not even the best investors in history can time the market. The best advice is to stick to your plan and keep investing. Bonus fact. Thank you for staying with us this far, dear viewers. Here's a bonus fact as a token of our appreciation. The leading cause of the Wall Street crash of 1929 was the long period of speculation that preceded it, during which millions of people invested their savings or borrowed money to buy stocks, pushing prices to unsustainable levels. The stock market crash crippled the American economy because not only had individual investors put their money into stocks, but so did businesses. When the stock market crashed, businesses lost their money. Consumers also lost their money because many banks had invested their money without their permission or knowledge. Question: what are your thoughts on the volatile condition of the stock market and the aggression of the Fed? Comment down below and let us know what you think. If you enjoyed the content, uplift the channel by hitting like, subscribe, and ring the YouTube bell to meet us again in the next video. Until next time.